You are watching TheoTrade. This is Don Kaufman doing the weekend update here. It is September 10th, 2016. All right, in this kind of weekend update, where to begin? S&P futures down 56, but let's not state some of the obvious. Friday, rough day, right? S&Ps are off about 2.6%. NASDAQ futures right in line with that, 2.6%. Russell took it on the chin over there, almost a 3.5% move. That is your index product that had what we would term a statistically significant move of over 3%. But again, I don't want to look at some of the obvious here on this weekend update. I want to look where I don't think a lot of traders are necessarily seeing some of the risks in front of them. So briefly, we're going to do an update, what I actually see in markets right now, but more importantly, we're going to be extremely forward-looking out to next week, what kind of risk you can expect. First and foremost, so the S&P futures down 56 points towards the end of the trading session, and I'm going to cruise over here. This is the S&P futures on a 9-month. I'm going to cruise over to a 1 minute, just a very clean chart, and take a look at what I term an all-out full-court press into the close. Not what you want to see on a Friday afternoon. That is, for the most part, when I say a full-court press, with seconds to go, literally seconds to go into the close over here, S&P sold off hard and fast on heavy volume. Okay, where does that really leave us? Well, more importantly than that, just seconds before now, granted, the markets officially close at 3 p.m. Central Time, right? That's what we term the cash close when the bell goes off. However, the futures continue to trade thereafter. And one of the things that is quite unusual to see is heavy contract size on a Friday afternoon, okay, that actually took the S&Ps down even further. What kind of situation is this? Well, this is for the most part traders saying, I don't want to sit here and hold the bag of risk, because come Sunday afternoon when they reopen the futures, that's what the bag of risk is going to look like. Remember, we closed the market Friday afternoon. Europe wasn't open. They haven't actually seen any brunt of selling. You know, Asian markets were already long since closed. All of those markets will be open prior to the U.S. market, and there could be a lot of fallout and a lot of risk, which I'm going to be talking about as we kind of move forward over here. But what was interesting to me, when I say there's some big contract size in here, if you take a look at the S&P futures, it doesn't look like that much, but you have to recognize right now what's highly unusual is that there's a roll going on. And the roll, again, the S&P futures, they drive the marketplace. It's absolutely critical to understand that everything you see on your screen, I don't care whether you look at the XLF, whether you're looking at Google, whether you look at an Apple, whether you're looking at a Tesla, the S&P futures, if they're going to get smoked, everything gets hit in alignment to a degree with them. It's all about, okay, volatility is all about correlation. And when you get bouts of volatility or a big down day, you're going to get almost one-for-one movement of most sectors. And what that basically comes down to is, you know, if you take a look at like Visualize over here on thinkorswim, listen, there's what? Every single stock for the most part in the S&P 100, it's what I call kind of a quintessential all-down day. So the unusual part in here, there's a roll going on. And the roll is moving from the SEP future to the DEES future. And a huge amount of the volume was still being done in the September contract. So for the most part, the intensity of the sell side activity, I don't think people were really respecting how intense it actually got out there, because they're looking at the DEES contract. Yeah, sure, the DEES did 2.8 million contracts, but do you ever think to look back over here at what we term the U6, which is the SEP contract, still has a few days to live. And what I found interesting is they were still whacking the markets with heavy volume, again, well after the closing bell there on a Friday afternoon. I mean, when was the last time you saw 10,000 contracts trade? Okay, just a second before they closed them down. And this is on Pacific time, but at 13:14, It's basically just seconds before they shut down the futures over there. Huge trade comes out. That's not a roll. That's just incredible size and volume, people trying to exit positions. So again, stating a little bit of the obvious, but I wanted to show you how intense it got towards that closing bell over there. It's the first time in an extremely long time that we saw that all-out push into the close. Now, here's some areas that you may or may not be aware of. Again, stating the obvious, the volatility picks up, right? That's what the VIX looked like. More importantly, the VIX spikes. Okay, but that's the obvious. There's some areas that I don't think most traders look at. One of those happens to be, cruise down to the bottom of the screen over here, what's termed the VVIX. The VVIX, it's the volatility of the volatility index. And what it's basically saying is, who in the world right now is buying volatility on the VIX options themselves? Now, the VIX options, they relate, okay, to the volatility futures. I don't want to get too deep into this. However, the VVIX got lit up. You think the Brexit was big? This is one of the single largest moves ever recorded on the volatility of the volatility. I mean, legitimately had a move from 85 to 110. Now, if you've ever tuned in here to TheoTrade before, when the VVIX, okay, hits the threshold of 110 on the button, that's the number we've used. Okay, for years I've been looking at the VVIX, and for years I've talked about the 110. When we hit 110 or above, and that's where we closed on the button, 110.02, you hit that, that's what we term put your helmet on, get underneath the desk, because it's about to get serious. Okay, what does that mean? Listen, the volatility, it's coming. And I don't know exactly what Monday is going to hold. We're going to talk about that momentarily because there are some pretty definitive signals out there. But I can tell you one thing, right? You basically just lit a match and threw it towards the marketplace. At this point, well, again, precisely what we're going to look at over here. The VVIX, though, is absolutely lit. It's something to really be cautious at this point. If I look back on like a 3-year, I don't care when you look back over here, you're not going to see too many moves, right, on the VVIX on a percentage basis that are that monumental. So the VIX options, they get lit up. But there's one thing I want you guys to keep in mind. When you're looking at volatility, stop looking at the obvious. Stop looking at the VIX, okay? All the VIX really measures is what's going on in terms of the options inside of the SPX. That's it. That's all it measures, okay? You know, people always say, the VIX is the VIX. They're right. All right, all it kind of measures is what's the intensity level, like who's bidding for puts in the SPX. Measures that intensity. More importantly, though, if you really want to get a good feel for what vol is doing, you got to look at volatility futures, and this takes a little bit of work. So, and that's why a lot of people don't look at it, because it takes, you know, a little bit of work. So I'm going to explain it, and this part is critical. All right, I'm going to draw this out for you the best I possibly can on this screen right now, but in terms of volatility futures, there are a multitude of expirations. Right now, you have this 11-day volatility future. It's right here. What's it trading at? Okay, it's trading for 1640. Then forget all these weeklies because they're worthless. See, there's zero volume, zero volume, zero volume. These, okay, the standardized volatility futures have some serious volume, although this is in the after hours. Okay, you jump out here to the 39-day. The 39-day, okay, here's 39 days. It's a bit higher. It's trading at what? Okay, 1775. All right, so what we actually are looking at here is what the 11-day volatility future is doing versus the 39-day volatility future, and it actually speaks volumes about what the marketplace views risk to be. They're saying in the next 11 days, okay, volatility is at about 16.4. Now, if that seems like an esoteric number, don't worry about it. We'll come to that in a moment. Then 39 days out, they're actually indicating 17.75. Okay. Now, if you go further out in time, they're going to indicate risk is even higher. Now, one of the things that's a hallmark of extreme volatility is not what you're seeing on your screen. Now, I'm going to say that again. One of the things that's a hallmark of extreme volatility is not what you're seeing on your screen. what you're seeing on your screen is we're still dropped into what's termed contango. Contango basically means out further in time, the risk is still higher. I mean, that's what you need to equate this to. Risk is still larger 39 days out. Why? 39 days from now, the unforeseen can happen. 90 days from now, it's even more unforeseen, right? There's more risk because there's more time. With 11 days to go, though, they're like, the risk is not too bad. What's unusual about this? Typically, when markets tank, and we kind of tanked a little bit, right? 2.6%. Again, that's not even really a statistically significant. Okay, in my book, you got to get over like 3% to really get me like running stats and so forth on it, but neither here nor there. Typically, when markets tank, what you actually see is the volatility futures, the short duration ones get lit. They get lit up. Normally, you'd see this about, 18.5, and then 39 days out, it would be 17.75. That would be what we would term, backwardation. Right now, we're still in contango. Contango! I know, it sounds cool. You sound cool at the cocktail party saying that too, right? I'm in a contango. So I think it contangoed. What this basically means for you. Why am I even covering this? Because we're not even catching our volatility stride. That's right. You're not even catching your stride in vol. Okay? If like volatility was really like alive, what you would actually see is the vol futures would flatten out. You'd see, first of all, you'd see the short duration maybe sitting at like 18, the back duration maybe sitting at 18, or even again, flipping into backwardation, 19 or 18 out there. But nope, you know where we are right now? We're in this garbage. We're over here at 1640 and about 18. You really want to see the short duration vol futures get lit. And that's what I'm talking about, That's what other traders are not going to see, which basically means if you think that we're in the midst of volatility, if you think that Friday was bad, think again, We ain't home yet. Now, if you want to point out the VIX, come on, the VIX jumped by 40%, neither here nor there. VIX doesn't even catch its stride until it's cruising north of 20. So you must put moves into perspective. Now, why do I say this? To scare the living crap out of you? Absolutely not. It's just to bring into perspective. A 2.6% move happens, and everybody's under their desk shaking. Should they be? Well, if you have a lot of risk on and you don't like it, I'm telling you right now, Sunday afternoon can get quite interesting when the futures re-emerge and reopen. Why? Well, again, as we saw, literally as the futures were shutting down, somebody's still trading 10,000 contracts. 10,000 contracts. Each contract is worth $100,000 in the futures. All the other stocks are closed. So you got to really wonder again what we're going to see on Sunday night as they reopen. There's a few scenarios that played out in my head, but these volatility futures speak volumes. And the volume they're speaking right now is, we ain't risky yet. I'll tell you when we're risky is when we flip into backwardation. So another thing that I don't think a lot of people are really recognizing, all this volatility that we're talking about that happened yesterday, it all has to do with the bond market. So a lot of people are telling me, well, it's the FOMC. Yellen did it to you. Yellen didn't do anything. As of right now, the market it's in the neighborhood of about a 26% probability of raising rates. That's what the market's pricing in right now. Right around the neighborhood of about 25% probability of raising rates in September. So you're telling me all this volatility, again, the media is always looking for something to blame it on. I want to be abundantly clear about this because this is a chart here on the ZB. But prior to the market having its little fit yesterday, the bonds already broke the prior day. The bond volatility was already there on Thursday. And everybody, here we're looking at it and we're like, whoa, because the bonds broke the range. Now, the bonds have been stuck in just a tight of range, as have been the S&Ps for the last, 7 weeks now. But the bonds broke to the downside. The interesting scenario here, though, we could have bonds tanking and S&Ps tanking. More interesting than that, and again, an area that I don't think a lot of people are looking at. Has anybody turned and looked at dividend-paying stocks? They got hammered on a percentage basis. Okay, the S&Ps didn't fare well, but take a look at something like XLU. What is it? It's the Select Spiders Trust Utilities. What does that mean? For the most part, it's utilities. They pay a big dividend, and this is the ETF version of it. It pays about 3.4%. Got crushed by almost 4%. There goes your dividend for an entire year in one day. So what you thought was safe, it's not safe at all. Okay, you want to look at other big dividend payers because the whole world's been diving into them. Here's Verizon. What happened to Verizon? 3.3%. How ironic. Another big dividend payer getting hit. Take a look, okay, at Philip Morris. Big dividend payer out there, down almost 4%. Okay, the reason I like to point this out, these stocks have been barking about them day in and day out. You don't see moves like this. Even when these things have horrible earnings, they don't move down 4%. You know, you can go on and on and on with all of these different, okay, stocks that are paying any type of a dividend got absolutely crushed. And that was, again, where we thought there was safety in the marketplace. In fact, instead of looking at the S&P 100, we can even go take a look at the sectors themselves, and you'll see the utility sector and telecommunications. Supposedly the two safety sectors down big. Bonds down big. Where do you hide? Do you go to gold? Nope. Gold's down. Why? Because the dollar had strength. When the markets reopen on Monday, forget about Sunday night, which I think there's going to be some serious volatility in the futures on Sunday night. I think it's going to be worth watching. In fact, we may even be broadcasting here at TheoTrade in our chat room come Sunday night. We're definitely going to be up early Monday because I'm telling you, there is going to be follow through to this. Okay. Now, coming into Monday, we're going to be watching the dollar very carefully. You know, people are wondering why gold is down. Come on, the market was getting hit hard. It's because, right, this is about currencies and this is about, okay, debt markets. And when currencies and debt markets start to go awry, what ultimately happens is we could get this huge influx into the dollar. This is the dollar futures over here. So if we influx into the dollar, strong dollar is going to crush commodities out there. Oil, yeah, guess what? Down 4%. Gold, down, okay? There's nowhere to hide. There's no sector rotation, all right? And again, the only place that people went to hide is they went out, and we know one thing. They bought volatility in the volatility product itself. The VVIX, okay, relates to the VIX. It's all we seem to know right now is, again, the VVIX up almost 30%. Some big moves out there. All right, forward looking. What are we looking like on Monday? Well, I'm going to tell you exactly what the market interprets. The market interprets risk on Monday. Well, Monday is September 12th. That's an expiration for Monday. You have about $25 expected move over there. Now, we've had entire weeks lately. We had 25-point movement. So now we've actually got 25 points of movement. That's just, again, into Monday's close. If you look out the entire week, well, this is going to be a little bit convoluted here because this is a primary expiration week, which ultimately means we have to go look at the spiders to figure out what is the risk out there. If you look for 6 days, this is on September 16th, which will be next Friday, you're looking just shy of about a $50 move expected in the S&Ps. Does it seem low? It still seems low to me because we did $56 of damage in the S&P futures in a matter of a few hours. The entire week, though, is still only priming for about a $50 expected move. I don't like it. I don't have to like it. Okay? What you do have to watch is this does not necessarily portend that we're going to tank throughout the course of the week. Quite the opposite. Volatility is all about the unknown. Okay? And if you were watching anything this weekend about markets and you know pop open a chart over here, I'm going to give you a first-hand knowledge. And it's not that I'm anti-technical analysis, anything like that. Okay? We just sold off, and right now, we're trading in the abyss. Don't tell me that there's levels down here. I don't want to hear, okay, the word oversold. You've been in an overbought situation for what? Let's look back over the last 5 years. Yeah, I could agree that we've been pretty much overbought for like 5 years. You can't suggest the idea, all right, of where volatility subsides. And the reason I'm mentioning this is because, again, it's been an extremely long time since I have seen markets have a little bit of fear pushed into them. And that simply means, again, what I saw at the close yesterday was what I call that quintessential full court press. No level saves you, okay? When ultimately algos grip hold and just start unloading positions. When dividend paying stocks are getting whacked harder than the rest of the market over there, you do have to have a little bit of fear. Right now, where do I leave you with this? You better be intimately comfortable with whatever your directional risk happens to be. Now, next week, coming into Saturday, it's Saturday, September 17th. It's going to be a 3-hour class. It's on risk twist spreads. Okay, risk twist spreads, what are they? They are spreads designed, okay, for imminent risk. How ironic that we're seeing that right now. Now, I have a risk twist spread on right now. Yesterday, it moved by 100% in terms of up. It moved up 100% in value. It's one little contract out there. But ultimately, the risk twist spread is designed exclusively for hedging, okay, in what can be utterly hideous market conditions out there. It's under TheoTrade.com/twist. Again, TheoTrade.com/twist. Those that are members of TheoTrade, okay, just go to the class. It's in our general chat room next Saturday, okay. I am more than happy to even share this trade with you. You can see it on the screen right now. It's a 1x3x1, but during this class, we're going to be going through highly structured and detailed criteria, a recipe, if you will, not only how to construct the trade, but more importantly, when to bail out of the trade, okay? When you see degrees of profitability, this trade can be used as a hedge, that is to reduce risk to the downside, or can be used simply because, hey, you want a good shot, if you will, to the downside in the markets. But we're already seeing on a percentage basis this trade react pretty violently to just 1-2% move down in the markets. Again, for those of you that are members of TheoTrade, you're going to the class. If you're not a member of TheoTrade, it's all right. Go to TheoTrade.com/twist. Check out exactly what we're going to be doing there at that class. Last warning for you. Again, expiration is coming up. There's a primary expiration. The ETF products like Spiders, they're going to be paying a dividend. Dividend is coming this week on the Spiders and major ETFs. Close them if you got them. If you got futures, you better roll your contracts this week because, expiration of the futures contracts is coming. It is known as the triple witch. Some people call it the quadruple witching. No, it's the triple witch. It's coming this week. Again, expect volatility. Things get crazy Sunday night. I'll be right there in our chat room with you. Thanks, everybody, for joining us here at TheoTrade. Have a great weekend. Bye-bye.